All right, welcome everyone. This is Bob Maurer. It is Friday, the 7th of March, around about 5 p.m. my time. I want to do a deeper dive into a strategy I introduced recently. It is number 351. It is the bear spread in feeder cattle. So I want to go over the particulars, talk about the backstory, and that'll let you know why I published this. And then we'll go in over the entries and exits, make sure everybody's on the same page. Okay, so let's dial into the portal here. Here is the most current PDF sheet, and the one I'm talking about is the bottom row here. Bear spread May versus August feeder cattle number 351. Margin requirement just shy of 800 bucks, and it's got one entry level only and three exit levels. Okay, and then there's the P&L for the risk and reward. Let's look on the chart, see how it all sized up. Okay. First of all, in yellow, like I just mentioned, strategy number 351, bear spread and feeder cattle, long August, short May. Margin requirement just shy of 800 bucks. And risk reward, risking 600 to either make 2,000 or 2,600 if it gets to target 1 or target 2. I didn't put target 3. We'll see if that one sticks. And here's the backstory. So this has been a profitable strategy during this seasonal time frame, 14 out of the last 15 years. The losing year was 2016. When I size up the chart you're looking at right in front of you there for the contracts we'll be trading relative to what happened in 2016, I don't see a whole lot of correlation in terms of the incoming price. Back in 2016, the seasonal started at a lower price. And then in terms of the structure, though, the overall structure of the market, in my opinion, I do see some correlation. So 2016 was similar to this year in as much as it was a generally buoyant chart structure going into the seasonal window. That said, in 2016, at one point, there was a $1,400 drawdown in the seasonal window. So what that means is the market rallied up during this window and then fell $1,400 before it closed higher. Okay, we're looking for price improvement because our benchmark is down here to negative 295 and the entry level negative 165. So that's a 130 point difference, which is a $650 difference. So that makes up for a lot of that potential rally, shall we say, that had to be sustained in 2016. So even though it did lose money in that year, at one point throughout the seasonal window, there was a pretty big drawdown. And we're looking for price improvement. So basically, that kind of sets up a structure where I'm not overly concerned. If all it did in 2016 was go from the bottom left of the start of the seasonal to the top right and never dips, well, that might be one reason to maybe look this one off. Although I would look at the structure of the actual individual front legs to compare to see what was going on those particular years to see if that was a real threat or not and maybe rule it out. But nonetheless, because this in 2016, the market rallied and then broke pretty hard and then rallied, I'm going with this strategy. So I like the numbers, I like the data. There was no other years, in my opinion, that really stuck out in terms of some rather large unrealized drawdown that we'd have to analyze and dig into. Our benchmark to stop range. So this seasonal started on Feb 27. Benchmarks at negative 295, where it settled that day. And our stop is negative 45. So that is a 250 point range between those two, which equates to $1,250. So that's the amount of room we're giving this particular strategy. And that would have been enough to stay on board 15 out of the last 15 years. So the math is such that based on the last 15 years, this should be enough room to stay on board. Okay, so that is why I published it. What are we looking to do? We're looking to sell a rally. So our entry level is negative 165. Our stop is negative 45. Okay, if we get filled, Our target's going to be way down here at negative 565 and 685, negative 685. And then target 3 is negative 865. See if that one stays in play. That'd be great if it does. And if anybody's a multi-lot trader or willing to risk a bounce and drop a stop to trail it all the way down to there, that'd be great. But we'll see how it plays out. It's going to take some time to figure out if that's going to be a really plausible number as time evolves. So that's the strategy. Generally speaking, looking at the Fibonacci's, I know a number of traders like to look at those. The 618 retracement comes in right near this negative 165, so that might be some resistance for us that would help out our entry level. But otherwise, we are looking for a reversal. So this is not trend following. Okay, this is counter trend. The market's been on nice little rallies break, as you see the pattern, all the way up until back in February 3rd, where we topped off. All right, and now it's had a little better break than usual, shall we say, over the last several months. But nonetheless, it remains to be seen whether or not it's going to go up and make new highs. So we are betting that it won't. And the seasonal is our driver. All right, that's in the driving seat. And the seasonal, my interpretation of it is such that it should get up around halfway, 6.8%. But that's not what this level, this negative 165 comes from me just doing the math and figuring out the average type of heat that would have to be taken. And that's what we'll get on board, basically using the market's propensity to move against the seasonal to our advantage. And it also just lined up with that 618. So that is a decent number, I think. All right. So that is that. We're looking to get short. Nothing done as of yet. Market's been basically chopping sideways for the last 4, 5, 6 trading days since this window started. And we will, as I said, patiently wait on the sidelines to see if either we get filled or if I need to adjust these entries at all. Okay. All right. Well, I think that brings everybody up to speed. If you have any questions, comments, anything of interest about this particular strategy, feel free to reach out. Otherwise, I'm going to leave it there. And thanks so much for watching.